In a past video, I repeatedly explained why traders almost never exercise options, but as it turns out, there are specific scenarios where exercising an option is actually a smart decision. First up are illiquid options. For instance, let's say you own a 30 strike put and the stock price is at $25. If you can't sell the put option for $5 due to it being in a liquid market, then you can exercise the put option and close the shares at the $25 market price to capture that $5 gain. You'd effectively short 100 shares of stock at $30, and then you could close those shares at $25 per share, therefore capturing that $5 benefit, which is equal to the intrinsic value of that put at that moment. The second scenario is when an out-of-the-money option that you own becomes in the money in the hour after the closing bell on expiration day. This is a very niche scenario, but this is a valuable thing to know. And I actually talked about this in my lost $30,000 on a $1 wide spread video, where a short put spread trader was actually seeing that their put spread was fully out of the money at the time of expiration. And Tesla shares actually plummeted in the hour after the closing bell. And this left their put spread fully in the money. And the trader on the other side of that short put that they had exercised the put option and therefore captured the value that the put option now had, even though the option was out of the money at the closing bell on the day of expiration. So if you own a call or put option and it is out of the money at the time of the closing bell on expiration day, and the stock moves big after hours and your option becomes in the money, well, this is a scenario where you want to exercise that option, because not exercising the option will lead to your option expiring worthless. Whereas if you exercise the option, you can actually capture the intrinsic value that your option has after hours on the date of expiration. Scenario number 3 is to defer taxation on a profitable option position. For example, suppose you own a 50 strike call that you paid $5 for, and this option expires in 60 days. Let's say the stock rips to $70 per share by the time this call option's expiration date. That means you will have a $15 or $1,500 gain on your call purchase. And if you don't exercise this option, you're going to have to sell it. And since you had a 60-day holding period, that means you're going to pay short-term capital gains on this $1,500 profit on the position. If you're a high earner, this means you are going to pay 30, maybe 40% in capital gains on that $1,500 profit. But if you think the stock is going to continue higher and you want to defer the taxation and shift it into long-term capital gains, meaning you hold it for longer than a year, if you exercise your call, you will buy the stock at the strike price of $50, and your effective cost basis will be $55 since you paid $5 for that option. So then a year later, after the exercise date, any profits you have on this overall position will shift into long-term capital gains taxes, which will be significantly lower, especially for high earners, compared to short-term capital gains taxes. Scenario number 4 is the clean unwind, or closing of your position. When trading a spread like a short put spread, if you get assigned on that short put before expiration, you will be left with 100 shares of stock purchased at the short put strike price and the long put option from your initial short put spread. Now, to close this position, you can either sell the 100 shares of stock and sell the long put in 2 separate transactions, or to cleanly unwind or close this position in one go, you can simply exercise the long put, which will sell those 100 shares at the long put's strike price. This is a much cleaner approach than selling the stock and selling the option in 2 separate transactions. You can close it all in one go by simply exercising that long put option. Scenario number 5 is the dividend capture strategy, which you may have heard of, but let me explain. If the extrinsic value of your in-the-money call option that you own is less than the amount of the dividend that a stock is going to pay out, then you can capture the dividend by exercising your call option, therefore becoming a stockholder and making you eligible to receive that dividend. Now, when you exercise an option, you're forfeiting the extrinsic value that exists in that option. So, for instance, if you have a call option with 25 cents of extrinsic value, but a stock is going to pay a 75-cent dividend, then you can exercise that call option before its ex-dividend date, therefore becoming a stockholder, but you will lose that 25 cents of extrinsic value. However, you will gain that loss back and then some by capturing that 75-cent dividend. I've always thought that it was better to just sell the call option and then purchase 100 shares of stock if you want to be eligible for that dividend, because that way you won't be sacrificing the extrinsic value in the call, and then you can also hold the shares and capture that dividend. However, as we've described earlier in this video, it might be advantageous to exercise that call option to capture the dividend if you want to defer taxation on that profitable call position, or if you are in a stock with illiquid option markets and you're finding it difficult to sell that call option at a good price. My name is Chris, and I will see you in the next video.